Now the TTR strategy, which is one part of it, is the salary sacrifice component. It was originally brought in by the end of the Howard and Costello era, and it was really about helping people transition out of the workforce rather than having to fully stop work to get access to their super money. They freed up access earlier to enable people to work part-time and meet the difference in lower income by drawing on their superannuation money. But the last point there is significant in that there's often greater benefit by continuing to work full-time and implementing the strategy, particularly once you're over 60 years of age and all the money that you draw from it becomes totally tax-free. So what are the benefits? The first one is salary sacrifice, as we've already talked about. If you salary sacrifice, then those savings, many thousands each year. There is also the tax-free income. So if you're over 60, what you draw from your pension is totally tax-free. If you're under 60, then it comes to you concessionally taxed, but it's not totally tax-free, depending on the components in your fund. So there is a greater benefit of the TTR strategy once you turn 60, but there often is benefit in moving to pension phase when you're under 60 as well. And then the third benefit is that when you move to pension phase, you're moving into the 0% tax rate pension phase versus 15% in the accumulation phase. So if you had $500,000 in your super fund and the fund earned 5%, then that's $25,000 of earnings. And if there was 15% tax payable on that, you'd pay $3,750 in tax. But if it was in the pension phase, you wouldn't pay that $3,750. So that's the third benefit of the TTR strategy. There are some, if the condition of release hasn't been met, that is, you've reached your preservation age, but you haven't ceased work or declared your retirement, then you can't draw out lump sums, and you can only draw down 10% of the balance. So if you've got $100,000 in your fund, you can only draw $10,000 per annum. So there's some of the benefits and restrictions around the strategy. Now, one thing that people often ask, or they don't really get how the strategy works, and so I've tried to devise this graphical illustration of how it works. Tony's just saying the TTR seems too good to be true. Yeah, relating to your question, Tony, about if you've got irregular income, then it actually works well with irregular income because you can change the amount that you draw from it. You can change the regularity of it. You can change how much you're drawing. You can roll it backwards and forwards. So there's full flexibility with it. So just to answer your question, Tony, about if you've got irregular income because you're self-employed or running a business, then it actually works really well because there's lots of flexibility with it. Now, just getting back to how it works from a practical perspective. Now, if you've got $200,000 in your super fund in the accumulation phase, then what you do is you leave a small amount in there. Now, I think it's $1,500 minimum balance with Christian Super, so we've just said $2,000 that we'll leave in our existing fund. Leave that there. With the other $198,000, then we roll that over to a new account. It's just like having two bank accounts. We roll it over to the pension phase of superannuation. So you've still got two grand in your accumulation account, your existing account. You roll over the rest to the pension account. So this is tax. The earnings on this is taxed at 15%. Earnings on this is 0%. So the next thing that happens is that you can continue to make your contributions to your existing account. So if you're eligible, you can put your $1,000 of non-concessional or personal contributions into the fund, and you might get $500 from the government. You might be getting employer contributions of 9.5%. You might be salary sacrificing into that fund. But with the pension side of things, we've got those minimum amounts that you need to withdraw. So between 55 and 65, you've got to draw 4% of the balance of the fund. 65 to 75, you've got to draw 5% of the balance of the fund. So those pension payments, those amounts have to come out of your fund. So you've got to draw that out into your bank account. But the thing is that people get concerned about is they think, I'm drawing all this money out of my super. I don't want to. I want to actually save that money. Well, if you don't use the money that you're drawing out of your pension account, you might need to use it for your cash flow if you're salary sacrificing. But if you don't need it to utilize that money, then you just put it back into your super fund again. Don't get too concerned about the fact that you're moving to pension phase, drawing from your pension, because it just then means that you might be able to salary sacrifice more, or if not, you can just put the pension payments back into your other account as well. So that's how the TTR strategy, or how you move to it, works from a practical perspective. You should also see some investment growth on both the pension phase and the accumulation phase. There's the same investment options. There's the 5 options of cash. So ethical cash, ethical stable, which is 30% risky assets, 70% defensive assets. There's the balanced option. I think it's called ethical my super in the accumulation phase, called the ethical balanced in the pension phase. It's 50% risky, 50% defensive. All the different options, the same options are available in each account. They've also introduced an additional feature that I think is fantastic, in that you can have multiple investment options, and you can choose the investment option within the pension phase that you're drawing from. So you can choose to have, say, $150,000 of your $198,000 in the balanced option, and hold the other $48,000 in cash and draw your pension from the cash option. It just provides that extra little bit of buffer, like a cash reserve that you've got if the markets go up and down. So that's something that you can consider if you're moving to pension phase as well. So you also get the investment growth on the accumulation phase as well. So that's the TTR strategy. Hopefully that's been helpful to you, and it answers your questions in relation to the TTR strategy and how it works. As I mentioned in relation to Tony, it is very flexible. You can move to pension phase. If you're finding that you don't want to stay in pension phase, you can roll it back to the accumulation phase. There's full flexibility there. If you are approaching or reached a preservation age, I would strongly encourage you to consider whether these strategies are applicable and relevant to you.